Everybody, what's going on? Welcome back to Stock Tips with AP here. Today's a good one because today I want to talk about a mistake, or really a lesson in my experience with YMAG. YMAG is one of YMAG's options income funds. These funds pay really high monthly distributions. I should say they pay weekly, sometimes 50, 60, and even 100% annualized yields. I got into YMAG because that monthly payout looked amazing on paper. Really, it wasn't just the monthly number, it was the weekly number. Like, the more often you get paid, the easier it is to see the growth. But with all those positives, had to be a negative somewhere. So here's what I noticed over time. The share prices kept dropping month after month, or dividend after dividend, pretty much. It was like after the dividend would hit, the price would drop, or even a little bit before the price would drop. And I thought in the beginning that it was kind of like market, the situation with the market with tech, but it ended up being much more than that. When the underlying stocks and it tracks were doing fine, the NAV erosion, the fund pays out so much in distributions that the share prices itself slowly bleeds down. So you're getting paid, but a chunk of that payment is really just your own money coming back to you, while the value of what you own shrink. Once I saw that pattern clearly, I made a decision. I shifted the capital towards more stable, more established, more profitable companies. Positions like ARCC, HTGC, SCHD, and even ET. I had a big fund. I think I was trying to push it to making it like $60 a week or whatever. And man, by the time I started losing, I sold off, and then I also went back into the positions I just listed above. The things with a longer track record of not eroding in the underlying share prices while still paying real income. But if you've seen it in my other videos, you can tell that HTGC and ARCC are both down in my portfolio, but I think they're good positions for the long haul. I'm not saying YMAG or funds like it are bad for everybody. Some people use them specifically and understand the trade-off. But for me, building long-term passive income, I'd rather have a slightly lower yield on something that holds or grows its value than a huge yield on something that quietly shrinks underneath. So for me, that was one of my key reasons why I got out of it, is because my underlying was going down. And even with the dividend, they would make so many adjustments to it to even when a dividend would come, it wouldn't buy enough shares to offset some of the losses. So I just determined that it was no longer, a really viable position in such large scale. Now, I still have the position in a much smaller scale, as you can see from the images. And I'll show you a couple of the dividends that I have received. And I did do some market buying the other day because my dividends weren't automatically reinvested. So I decided to stay in a little while. So 16, 16, 19. So that was pretty good for the month of May. And then look at the month of June so far. We way down, 12 and 11. So I bought $30 because I needed the share count for the dividends that may have been missed. So that's why I did that. So that's the YMAG lesson. If you've held any of these high yield option funds, let me know your experience in the comments, good or bad. I want to hear it. Subscribe if you're following this journey. See you in the next one.